Right, so guys, now let's finish off then the first past paper over here. Right, so question number 4, if I'm not mistaken, will now be advanced levels. Right, 2012 question. Right, so number 1, same as the last question. The first thing what I did was, right, I went through my requirement over here. So they're asking for 5 ratios. So as always, I set up the table, right, formula, substitution and answer. And step number 1, you copy down the formula that is given in the first 2 pages of your document, right? So after that, it's a matter of simple substitution, right? Number 1, the first thing what they have asked over there is quick ratio. So quick ratio is current assets minus closing stock, divide the whole thing by current liability, right? Number 1, we must search for current assets, right? So as you can see over here, specifically they have given you a topic called current assets, right? Number 1, they have given you closing inventory of 300, okay? Right, now over here, inventory as at 1st of April 2011, right? So I'll mark over here and keep, right? Now this is your opening stock. Right, now remember, generally under current assets, you only mark the closing stock, but they have given us the opening stock also. So let's see why they have given that. So for the time being, just omit this part. Right, and then they have given for you, right, debtor is 400, cash and cash equivalent 50. So over here, current assets, inventory is 300, debtor is 400, cash is 50. So therefore the total over there will now be 750, right? So we mark over there 750, right, minus, as you can see over there, right, closing stock. So here closing stock over here is now 300, so you deduct 300 from that. Prepayment, in the last video I explained, you generally don't see prepayment. Like as you can see over here, there is no prepayment, so that's 0. Right, divide the whole thing by current liability. Right, see here specifically they have given for you current liability is also 300, so you mark that over there. Right, so therefore use your cal and get your answer. Right, so that will now be 1.5 times. So that's done. Right, so remember quick ratio, I already explained the purpose of the quick ratio in the last video, so we can skip that part. Right, next one. Right, inventory turnover ratio. Right, so again when you look at the formula sheet, this is the formula for inventory turnover. Right, number 1, cost of goods sold. Right, so remember, cost of goods sold means they are simply asking for cost of sales, right? So when you look at the data given for you, right, as you can see, right, cost of sale is 2200, right? So you go and mark that one, 2200. Right, average stock. Right, so I'll mark it over here. Right, now remember, in accounting, if they want you to calculate average stock, right, so what you should be doing is, right, number 1, you get your opening stock plus your closing stock right, and you divide the whole thing by 2. Okay, right, so remember again how to get average stock. Generally, how do you get average stock? It's opening stock plus closing stock, you divide the whole thing by 2, right? So number 1, let's search for the opening stock, right? So this is the reason why they have given us the opening stock over here. Opening stock, as you can see, is 500,000, right? So we'll take that as 500 over here. Right, so open bracket 500 plus the closing stock. So as you can see, the cursor is showing here, the closing stock is now going to be 300, so you add 300 to it, right, and divide the whole thing by 2, right? And whatever the answer that you get, you please give it in times. Right, so that's going to be now 5.5 times, right? Okay, inventory turnover ratio, what does that explain? Right, now remember, inventory turnover, as you can see over here, we have got our answer as 5.5 times. It means in a given financial year, the number of times that you're selling your stock is what is explained through an inventory turnover ratio. So again, one more time, what do you mean by 5.5 times? 5.5 times means in a given financial year, 5.5 times you have sold your stock, and converted that either to cash or you have sold it on credit. But the basic point over here is the number of times that you have sold your stock in a given financial year is what is explained through this ratio, right? So for decision making, the higher the inventory turnover, that means the more number of times that you're selling stock, it's always better for the company, right? Next one, return on total assets. So this ratio we did in the last video as well, right? Number one, we need profit after tax. As you can see, profit after tax means profit for the year, right? So you go and mark that one over there, 400, right? Plus we need the interest, right? Now unlike the last paper, you don't see something called interest in your data, but then can you see there is something here called debentures, right? So what do you mean by debentures? Debenture is when a company goes and takes a loan from the public, that is what you call a debenture, right? So over here we have taken a debenture worth 500 and we have to pay now a 15% interest. So what you do is on this 500,000, see 15%, that will now be, right, 75, right? Divide the whole thing by total assets. So last question also we discussed, right? So what do you mean by total assets? So total assets is normally current assets and non-current assets. So non-current assets specifically they have given for you, as you can see over here, 1250. Current assets, can you remember we took that in our earlier ratio, which is going to be 750. So 1250 non-current assets, 750 current assets will now give you a total asset of 2000. Right, so again use your cal, multiply and you get your ratio over there. Right, so the answer will now be 23.75 times, sorry, 75%. Right, you don't have to give it specifically. If you need, you can round this off to 24%, no problem about that, right? Next one, debt to equity, right? Now remember, debt to equity is another one name for gearing ratio. So this is also something what you did in the last question, right? Number one, debt capital. So last question I explained to you that debt capital means what? Non-current liability. So what are the examples of non-current liability? Bank loan, lease creditor, and also debenture. So the only thing what you can see over here is debenture, right? So you go and mark that. So debenture is 500. Right, owner's equity, that one also I have given you the formula in the last video. Owner's equity means what? Ordinary shares plus reserves. So in this question, ordinary shares are 600, reserves. So what do you mean by reserves? One more time, retained earnings, general reserve, and also revaluation reserve. So in this question you don't see general reserve or you don't see a revaluation reserve. The only reserve what you see over here is retained earnings. So again, equity means what? Ordinary shares plus reserve. So the only reserve is retained earnings. So when I add these two together, I'll now get, right, 1000. So therefore the answer over here will now be 50%. Right, last one, interest coverage ratios, right? So interest coverage ratio is a new ratio, right? The first thing what they have given over here is profit before tax, right? Now here we have a problem. Here the profit what they have given for you is profit after tax. So the only thing what you should do, the question is asking profit before tax. So if profit after tax is 400, right? So I'll open bracket and mark there 400. But I need profit before tax. So the only thing what you should do is, since this is profit after tax, you add back your taxation to find your answer, right? So as you can see, income tax over here is 200. So you add back 200 to this. Right, so again for the ones who didn't understand, one more time, profit for the year means profit after tax. Now when you do company account, what you do, you take profit before tax, subtract taxation to get profit after tax. So the only thing what you should do is you should do the reversal. Taxation you normally subtract, but to get profit before tax you add this one, right? So that will be 600. Right, interest. So again remember, interest is something what you already found in this equation. As you can see on the cursor, the interest is now 75, right? So you go and add back 75 to this. Again you should divide the whole thing by total interest. So again down you have to mark the same interest what you marked over here. So interest, from where did we get this answer? This is the same 75 what we used over here. Again The 75 is from 500,000, 15%. The same interest what you mark over here only should be marked down also, right? So you use the cal and get your answer over there. So right, that will be over there 9 times. Right, so this is a new ratio, right? Interest coverage ratio. What does interest coverage ratio explains? If you take a loan in a given year, how many times are you able to pay interest? That is what is explained through an interest coverage ratio. So one more time, when you take a loan, what is the company's capability of paying the interest? So in this case, this organization can pay interest 9 times for a given year. So if you are to make a decision, higher the ratio is, the better it is for the company, right? So guys, with this we have done 2 questions over there. So now I will want you to do the 2013 paper and the 2014 paper on your own. I'll give the question numbers on the group, and if you have any doubts, again you can message me and ask on how to get the given figures, right?